Hi everyone, I'm Connor Darrow and I'm the portfolio manager of the group.
I'm Danny Smurs, and I was one of the analysts.
I'm James Odo, and I'm the CCO.
I'm Andy O'Neill, and I'm an analyst.
And I'm Nathan Zerpolo, I'm also an analyst.
For our portfolio, we wanted to employ a growth at a reasonable price approach. This is evidenced by our buy and sell characteristics. We utilized Bloomberg for our screening process.
For our screening process, we wanted to make sure that we were buying stocks that were relatively cheap and shorting some of the stocks that were more expensive compared to their peers. We also wanted to make sure that stocks on the long side were growing steadily on both top and bottom lines, and the reverse to be true for the stocks on the short side. For our long screening, we started by taking the stocks from the Russell 1000 that were experiencing quarterly EPS and net income growth of above 5%. Then we wanted year-over-year revenue growth to grow by 10%. We then screened for valuation ratios, including price to sales less than 5 times, price to book less than 5 times, price to earnings below 35 times, and EV to EBITDA below 10 times.
Overall, we wanted to be as beta neutral as possible, even though that requirement was removed. We ranked each category for the top 20 and bottom 20 and used that combination in addition to the beta weight to determine our conviction in the position regardless of sector. This led to stable income, dividend yielding, and generally much higher quality portfolio. Lower betas received a higher weight given most companies had higher betas due to this sort of screen. We created our portfolio without trying to market time, so sector performance ultimately drove a large part of performance for better or worse.
Our screen for the short portfolio was similar, but the reverse of those parameters. We took the quarterly net income and sales growth and found companies in the Russell 1000 that were growing less than 5% and had year-over-year revenue growth of less than 15%. Then, from those, we took the valuation ratios and looked to see if they were overvalued. We wanted price to sales to be more than 1.5 times, price to book to be more than 5 times, and price to earnings greater than 25 times.
Due to friction, we had a smaller sell list, and so we ranked the top 10 and bottom 10 by category to determine our conviction, and given the higher betas on the screen, we had to more heavily weight the smaller beta cells. Higher betas received a higher weight given most companies had lower betas due to this sort of screen. We reviewed beta as our main source of risk in our portfolio, so we kept it around 0.1.
In terms of our portfolio construction and trading, in terms of trading specifically, we did not trade more than we had to. We traded mainly at the beginning. We didn't want to incur higher transactional fees, and we really believed that we just wanted to have our strategy play out. In terms of portfolio construction, our portfolio consisted of a heavier long position on industrials, which contributed about 35.5% of our portfolio, translating into a negative 69 basis point return. We shorted a larger portion of our healthcare industry and IT. However, despite this short position, it didn't compensate for the ill performance on our long positions.
When looking at the risk of our portfolio during different financial downturns, our portfolio would have been up 26.5% during the dot-com bubble. Our portfolio would have actually done better in any of the major financial downturns in the last 32 years than it performed over the course of this challenge, excluding the Russian default crisis. Comparing our portfolio to that of its performance during the time of the economic downturn, our current return of negative 8.7% as of February 9th is a bit of a surprise. While we were unable to predict the Q4 correction period due to the past periods of economic downturn, our portfolio should have performed more admirably. It could have been expected that if technology had underperformed, we would have seen returns like that of during the dot-com bubble. Our exposure to industrials and materials was a direct cause of our underperformance due to the industrials negative 13% return and the materials negative 15% return, according to the 2018 Baird research. Comparing our sector exposure to that of the downturns in the Q4 correction period of 2018, our portfolio took a huge hit. It would have been difficult to predict the exact economic sector performance during the correction period, but we would have been able to avoid a good amount of risk if we had more sector diversification.
The way we screened put more emphasis and weight on different sectors. Because of that, industrials accounted for a large section of our portfolio. It underperformed, which caused the portfolio to underperform. We should have been more diverse. Our top 5 portfolio performance factors were earnings yield, medium term momentum dividends, dividend yield, market sensitivity, and liquidity. These performance factors show that the short-term performance play and a quantitative approach could have worked if we were more diverse or if industrials would have outperformed the market. The quantitative strategy paired with an idiosyncratic risk was the main reason the portfolio underperformed. We should have combined a qualitative stance with our quantitative approach, diving more into the specifics of each company's business models. With a beta of 0.1, we are going for a beta neutral approach. It is unfortunate our heavily weighted sectors underperformed because when comparing our portfolio to different recessions, we would have fared well.
Thank you very much.